Previous day's high and the low are very important levels, especially to the institutional investors. So that's why when the market reaches the levels, there are certain behaviors, either respect them or penetrate them. So in this video, I'm going to show you how to leverage the previous day high and the low in terms of the New York Open strategy trading. There are mainly two uses of the previous day's high and the low. First one is to help with the trading setup, and then it's gonna be a trigger to the trade start. And then the second use is to use as the profit target. First, let's take a look at how it can help with the entries. So in this chart, we can see that after the New York Open here, the market doesn't go anywhere, and then it consolidates a little bit here. First, right upon the open, it is not breaking out, so it is not the breakout strategy. You can certainly draw a range based on the open range here. So basically you can see this range covers most of the bars here, and then we can say we're waiting for the bar to break this range and then go to either downside or upside. It depends on which direction it's breaking up. However, this range dragged too much from the open, so this range breakout and test strategy may not work very well, and then the probability is low comparatively. Still, if you want to trade this strategy, here's the breakout to the downside, and then you want to wait for the market to go back to test the bottom of the range here, and then market goes down. So it is tradable, but what I said is the probability of this strategy after the opens a long time, and then the probability is very low. That's the point. What else do you notice on the chart? Basically, there's a previous day's low level here. And then you can see that the market lingers above the previous low and then pierces this previous low here. And then this is a level breakout. The level means the previous low. And then you can see it pulls back to retest the previous low. So we can certainly trade this chart as the previous low level breakout and the retest. Combining with the previous range here, range break and the retest, we are having a higher probability that this is a good trade. So we can trade accordingly based on this setup. Why this works? Because if you notice here, previously it tested the previous low from above. That means it respects this level. And then somehow it doesn't hold anymore and then break it. So you can see the break bar here, it penetrates very greatly. So that's why this level can serve as a setup. And then after breakdown, here is a signal bar, there's another signal bar, and then there's one push, two push, and three pushes. So this is a very good setup, and then you can trade accordingly, either scalp or swing. Let's take a look at this chart. The difference between this chart and the previous chart is that there is a fluctuation before the open in the pre-open market here. So here there's a breakout to the upside, but there's no follow-up. And then after the New York Open, you can see it goes down a little bit, so the whole thing is a range. In terms of trading this, we can also leverage the previous day's high and low. Here there's a previous low as well, and then we can see that the market breaks this previous low here and then retest a little bit. Even though you can see the break is not very strong like the previous the chart, the break is go down directly here, it lingers here a little bit, but it really doesn't matter. This previous day's low, you can see it pause here, it respected, then it is a very good setup. And then you can see that this pullback is very small. By reading the candlestick, you can say the pullback is very shallow. That means the downside pressure is very strong. So based on the analysis, after you see this big bear bar, this can serve as a signal bar, and then you can go down and then trade accordingly. Here's another example of the uptrend to demonstrate the previous high and low. Basically, this is the previous high here. You can see that even the pre-market goes down, but this opening breaks this previous high greatly with this huge bull bar, and then follow up with two bull bars here. So this is a breakout, and then you can see the trend goes up. This is another example that this previous day high is very robust. Further to say about this breakout, you can see the breakout here goes above the previous high from below. This is very important, and also the pullback stays at the top of this previous high and then retest the previous day high. So this is a setup. But if the market goes down too much below the previous day high and pull back, then this strategy may not work well. Here's an example of the range break and retest. So basically after the open, you can see there's a range here. And then the market breaks to the upside and go down to retest the top of the range. It didn't reach it. That means the trend is very strong. So basically here should be your entry. This is the signal bar, and then you can trade up here. You can see the entry level is at the top of this range. If we use the previous day's high, this is the level here. You can see the pre-market try to go up to penetrate it, and then goes down and then go up again. So this can be the level breakout period here. So even though it goes down here, but take a look at the candlestick here. This bear bar with a very big tail at the bottom, that means the support. So you can choose to trade when you see this, but the probability is not that high. And then you can wait for the market to go down again to test the previous day's high here, and then it didn't even go down anymore. So a best entry is to use this as the signal bar. This bull bar is a trend bar, and then after the trend bar finishes, you can put your entry at the top. So you really need to be flexible when you use the previous day's highs strategy here. And another thing is also combining with the reading the candlesticks. Take a look at the behavior here. Even though it goes down here, still there are 3 doji bear bars here. That means the downside pressure reduced greatly, and then the next bar is very strong bull bar going up. So that's why by reading the candlesticks, combining with the previous day high, you can see your entry is actually at here. Comparing to the previous range break and the retest, your entry is here. This is high than this. So by using the previous day's high, you can have a better entry level and then make more profit. In the previous example, there is a fluctuation in the pre-market. But in this example, you can see right after the open, it's lingering here and then form a range, and then breaks the range, retest the range. So basically you can use the range break and retest strategy and enter here. If we draw the previous day high here, you can see right upon the open, it breaks the previous high from the below to above and then consolidate again. And then you can use the bull bar here or bull bar here as the signal bar to enter the market, and this part is also retesting the previous day high. One thing is the consolidation of the pullback here is above the previous day high, so that increases the probability that the market will go up. And comparing to the previous range and retest, you can see range retest entry is here, but if you use the previous day high, your entry is here. Definitely you can make more profit. The second use of the previous day's high and low is to serve as the profit target. So in this chart, you can see the market goes down here. But where can you put your profit target? Here is the entry if you're using the breakout to the downside here, pull back, and then this is the signal bar, so we enter here. And then you can set your profit target at the previous day low. Here's the previous day low. You can see the market just go down to test it and then reverse greatly. So this is a very good place for you to take the profit other than any other techniques. The reason that we can use this previous day's low as the profit target, like I mentioned in the very beginning, a lot of institutional investors, they have their own levels there. So they do not want to see the market goes down below the previous day low. Maybe they have a lot of position there. So that's why the market goes up. Or if there's any algo trading that it triggers the entries from the algorithm. So that's why it pops up greatly. In this example, you can see we have the first leg here, pullback, and the second leg. Why the market didn't go down continuously? Because there's a previous day's low here. And then you can see after the second leg here, the market lingers below the previous day low, and then eventually it breaks to the previous low and then go up. So that's why this level is very important. When you see the market lingers or consolidates around the previous day low, it's better that you exit your trade if you're in one. In this example, we can definitely see that 8:30 there's an economic event. The market goes up a lot. These lag with 5 consecutive bull bars going up a lot. However, the market didn't go up continuously with the second leg with the same distance as the first leg. Why? Because there's a previous day's high. So the market goes up, try to continue, but it goes down. That's because it hit some others trigger to short. So that's why when you see this previous day high, it's better that you take a profit, and then if you want to swing, you can leave some of the rest of your position, but mainly you want to take most of your profit at the previous day's high level.